What I wish I knew about the repo rate before diving into finance. It's one of those terms that gets thrown around a lot, but understanding it can really change how you view the financial world. Trust me, it's a game changer. Once you grasp the repo rate, you'll see how it impacts everything from your loans to the overall economy. So what's the repo rate? It's the interest rate at which the central bank, like the Reserve Bank of India, lends money to commercial banks when they're short on funds. Why is this important? Because it directly influences the cost of borrowing for banks, which in turn affects the interest rates they offer to consumers and businesses. When inflation is high, central banks hike the repo rate to make borrowing more expensive. This discourages spending and borrowing, which helps to cool down the economy. This reduces the money supply, cooling down inflation. It's a delicate balance, but central banks use the repo rate as a tool to manage economic stability. Conversely, when inflation is low, they lower the repo rate to encourage borrowing and stimulate the economy. This makes loans cheaper, encouraging businesses to invest and consumers to spend. Think of it as a financial thermostat, regulating the economy's temperature. The central bank adjusts the repo rate to keep the economy from overheating or cooling down too much. High repo rate, less borrowing, less spending. This can slow down economic growth, but it's necessary to prevent runaway inflation. Low repo rate, more borrowing, more spending. This can boost economic growth, but if not managed carefully, it can lead to inflation. So next time you hear about repo rates in the news, you'll know it's not just numbers. It's a critical tool that central banks use to steer the economy. It's the central bank's way of keeping the economy running smoothly. By understanding the repo rate, you can better grasp the broader economic picture and make more informed financial decisions.